Good day, fellow investors. The new JPM guide to the markets is out for Q4 2022, and we are going to go through the most important topics and beautiful charts the JPM offers here, as we do every quarter. And the key topics and my summary is that things are great, but the question is for how long? On the other hand, things are cheaper in the market, and then the question is whether to invest on fundamentals or other. Even the perma bear Michael Burry has said that low price to cash flow businesses might be an opportunity now as those buyback stocks, and as Graham said, that makes them statistical values, math problems that more or less must work out. And then Graham says also cheaper debt for, let's say, buying it back, those companies that have the cash, but then again, better off buying the stock because sooner or later the debt will then also be easier and refinanced. So in that environment, let's start with the market overview, but before, if you enjoy it, please support the channel by smashing that like button. We'll start with market valuations, then dig into the economy, the dollar, inflation, interest rates, what's going on with monetary policy, the outlook for the economy, fiscal, and the impact of the current changes in interest rates on everything longer term, discuss how the inverted yield curve signals a recession pretty soon, 6 to 12 months, most likely historically, but also from the agenda and what's going on, and then discuss also how to invest. Always keep in mind the stock market anticipates. So the stock market might already anticipate a recession now, and then you never know, rebound during a recession because it already anticipates a rebound then in the economy. Let's start. Now, everyone is focused on the recent stock market crash, 25% down, now already a little bit late as their charts go to the end of September. But all in all, the market is where it was just a while ago. So this isn't such a big, crazy situation, disaster. If you just look at what the market did over the last 20 years, so nothing wrong there. But if you look at the forward PE ratio, it's at 15, here it was at 20, and it was usually much higher when something crashed. But then in 2007, everybody also expected good forward earnings. That of course changed. So we are in a mid-risk situation, mid-reward, where we don't know whether the direction will be up or down. We'll later discuss how to deal with that. Now, when it comes to earnings projections and valuations, always keep in mind this is Wall Street. We are summarizing margin of safety. Yesterday we did chapter 5 already, but in chapter 2 we discussed how Wall Street has always a bullish bias because Wall Street wants for stocks to go higher and higher, and that's why you will always see that they use forward earnings, forward 12-month earnings, and forward PE ratios because those forward include future growth, expected growth, and make everything look better. So now we are then again below the 25-year average. They are not using 60 years because then this chart wouldn't be that beautiful. Again, keep in mind Wall Street's bullish bias, and if you look at the earnings, we are here now, but everyone expects forward earnings in 12 months to jump around 10%. So that is the bullish bias. However, if we look at reality and real S&P 500 P ratio, that's around 19, which is still historically on the higher end and therefore signals still a risk in the form of valuation, even if the forward P ratio is high. But keep in mind, and I've been studying recently Druckenmiller, more about that in the next few weeks, but he says that a strong dollar, rising rates, and high oil usually are very negative for corporate earnings, and therefore we have to take these earnings growth expectations with 2 pinches of salt. But if we look at the risk and reward, even from these forward earnings, we can see that we are historically somewhere at the mid-reward and also mid-risk. Of course, you can lose a lot, but you can also gain a lot going forward. So Longer term, 5 years, again, really a mid market risk and reward. So that's something we have to keep in mind when it comes to the market. Of course, as stocks are lower, that immediately tells us that the reward is better and the risk is lower. That is investing. Let's now look at the economy, which will tell us about the long-term outlook, especially on real returns. Nominal might be also great because of the economy. Let me explain. This is just a nice chart showing how recessions come and go. Recessions are normal, so nothing wrong there. Always good to expect a recession, and recessions will come. But then at the end, we see the growth projections, and everyone expects the economy to grow around 2%. But when I look at this, I see 68.4% is based on consumption, and there we might see some issues down the road, especially next 12 months. But if we look at the economic monitor and the broad indicators for a recession, nothing wrong there, so all still very positive. Lower recession risk, consumer services still in the green. Manufacturing has crashed, so that is the one economic monitor key elevated recession risks, and the labor market is still extremely strong in the US. So from this perspective, not yet recession ahead, but from other perspectives we'll see later, very likely recession ahead. Plus, US consumer confidence is at the bottoms, and it has never been so low over the last 30 years, and that is because we have inflation and also the impact of higher rates. But let me show you a very interesting chart. So this is Consumer Sentiment Index and subsequent 12 months investment returns. And whenever the index is low, is in the negatives, 43%, 15, 22, 14, 32, 29, 20, 22. So be greedy when others are fearful, and then you can expect positive returns. When everyone is greedy, look at the returns. Single digit at best, and except for February 2020 with the stimulus and money printing, everything was much, much lower. So from peak, 4.1% returns, from troughs, 25%, thus signaling it's again a good time to buy stocks. Let's discuss inflation. So inflation has not been this high for 40 years. Thus, this is a new factor that most of us haven't lived. I lived in a communist country, so I have seen it then with the war. For the first part of my life, I know what inflation is. Most of you don't, but let's discuss it. Apart from inflation hitting all the developed world, we also have now a very, very strong dollar, despite the US trade balance being negative, but the dollar has higher positive returns, yields, compared to other countries because the Fed started hiking sooner, and therefore demand for the dollar is there also as the global reserve currency. The Fed is now at 3%, and it is expected that it will reach 4 point something in the next year, 2 years, and then in the long run again go down to 2.5%. They said they will lower the balance sheet, thus revert the money printing, but for now it has been just talk, as this mountain hasn't yet started sliding, and we have to see whether these expectations will be possible, but it's more likely that it will be something like this, because this would really hurt the economy, and it is uncertain whether there is the potential for lowering the balance sheet that much, because if you look still at real interest rates, and that is what matters, real interest rates, despite the hikes, are still negative, thus still extremely stimulative for the economy. Yes, nominal yields are there, but if you compare it to inflation, the real yields are negative, thus stimulative. Then if we look at the global situation with central banks, you can see here that everyone is at the current moment still in printing mode, still stimulating despite the inflation. Yes, they say they will hike, and how much is already priced in. Okay, they've done that, but still not as really aggressive as one would hope or expect to see here. And I am very, very curious whether we'll see this in the future or not. Now, on inflation, the dollar and the Fed could be forced to stop sooner rather than later, which means that other currencies might catch up and the dollar relative strength might be a little bit lower. Inflation might be higher than expected. Everyone expects 2% long term. Ray Dalio said 5%, and everything is still stimulative. Don't forget that money is still being printed and interest rates are still negative. And on top of everything, if we look at the yield curve, this is the yield curve end 2021, normal, longer term maturities have higher interest rates. That's a given. But now you can see here that shorter term maturities have higher interest rates compared to longer term maturities. Why is that? Because investors are flocking to longer term maturities to get a hold of this higher rate, expecting rates in the future to decline, and therefore there is more demand for this. And for shorter term, you need to pay more than what is the Fed's rate, which leads to an inverted yield curve, and that is the best recession signal ever and has been at least over the last 50 years. Inverted yield curve, okay, small recession, but pandemic and everything. Inverted yield curve, 2009 crisis, 2000s again recession, 2000, 1980s recession, and early 1980s recessions. The inverted yield curve have been a great indicator of what's going forward and a signal of a recession. And if you increase interest rates, if you pull out money out of the system, you, of course, pressure spending. And if you want to lower inflation, you have to pressure spending, which obviously leads into a recession. There is nothing special about it or nothing to worry. It will be a soft landing. Will it be a bigger crash? That is unknown, and that is something we will have to see. Because this is the issue. If you look at global fixed income, this mountain of debt, the global bond market, is $140 trillion. And the US has 50 trillion, another 50 trillion, Europe, Japan, and then emerging markets, just 36 trillion. But if you look at this, look at what happened to interest rates. Interest rates average in the US went from 1.75 to 4.75. 3x again globally, except the US. Japan also 3x. Germany, what is this, 80x or something like that. So interest rates went from a decade of practically zero to now significant 3-4%. And this has a big issue on everything, especially as the world is extremely highly indebted. And this has a huge impact on fiscal finances. This is my favorite chart of JP Morgan showing the federal finances, but what they don't show is the federal public pile of debt that has reached 30 trillion and more, but they don't show it because it hurts and they still are Wall Street, but they don't want to explain it. Now, if we look at the net interest cost in the budgets, those are 400 billion per year, 7% of the total spending. That is an interest rate on the 30 billion of 1.3%. However, as interest rates go up, if interest rates go to 4%, the cost of that debt is 1.2 billion. 1.2 billion is a huge impact on total spending, and what 20% of budget can be spent on just interest, which is a terrible situation. And this is where it looks most ugly, but somehow nobody cares. Why? Well, this is why. Because, of course, Credit Suisse isn't on the brink, Wall Street isn't on the brink, because everyone is connected to those interest rates. Everyone lives in Wall Street in finance on that spread, borrowing cheaply, investing into something and gaining on the spread, on the fees, on everything. It is no one's interest on Wall Street to discuss the panic around the pile of debt and the interest rates, because it isn't their interest. Nobody cares. They want to make as much money as possible as fast as they can, and therefore you will not see these discussions except for the shadow finance areas or like YouTube here. What will happen? I wish I would say we will see and that it will be positive, but I have to say we will see, and we will see how negative it will be. You cannot borrow endlessly without ever thinking that it will be at a cost. Because what everyone is projecting is the deficits just to continue and every government to just borrow in eternity. And we now see that that is not possible because of inflation. Now, when it comes to investing, should we invest or shouldn't we? I feel we should, despite the terrible out there. And we did this Google video discussing how, okay, conservatively we can expect a 10% return. Based on Wall Street, it should be a 20% return. But even if it is 0 for 5 years and then it goes, I don't know, 7%, it is still good from an investment perspective. So it is impossible to predict, but the fundamentals are cheaper and we have to focus on those fundamentals. We cannot know for recessions what will be the reaction, whether there will be more money printing, because when the Fed blinks, stocks will boom. That's a given. And if we look at the S&P 500, it has been pretty volatile, searching for that direction, and therefore explains that the market is in a mid-risk, mid-reward situation, searching for what will happen next and waiting for the Fed to blink. But my opinion is that we should invest into fundamentals now and invest in something that you like, no matter what the Fed does. As I said, I've been studying Druckenmiller a little bit, and then he discusses how, okay, England is already unfolding, but when he puts all of that together, he says that we can have a period of 15, 20, 10 years where the market doesn't go anywhere. That doesn't mean you can't make money investing in the fundamentals. You could have made plenty of money in the 70s. At various times we had 260% rallies, so expect anything out there. But we have to understand that we have had a hurricane behind us for the last 30 years, 40 years, and now it's reversing. So the key is that we invest in fundamentals, because he wouldn't be surprised if the Dow won't be much higher in 10 years than it is today. So fundamentals, buy businesses that will do good no matter what. If you like that idea, smash that like button, and I'll see you in the next video.